Hello and welcome to Steal the Show with Michael Port, a podcast from Heroic Public Speaking. I'm your host, Michael Port. This season's theme is Speakers with Money. I'm joined by my very good friend, Matt Zepka, the owner and chief wealth strategist at Valley Oak, a specialized financial services firm. Together, we're exploring some of the most common and daunting challenges facing speakers, entrepreneurs, and small business owners when it comes to finance. Now, to be crystal clear, I have no conflicts of interest here. I don't stand to make any money at all from you adopting any of the educational content you hear on this podcast. My company is Heroic Public Speaking. We're a public speaking institution based in Lambertville, New Jersey, and we provide world-class training to aspiring and working professional speakers around the world. I don't sell anything related to financial services. Matt, however, does, and you are welcome to hire him. I do. I will not be compensated, however, in any way at all if you do. I'm doing this purely because I love this topic, and I think everyone in our industry can benefit from learning more about business and personal finance. That's it. All right. Today, we're discussing asset allocation. So let's get right to it. Matt, how you doing?
I'm doing great, sir. Doing great.
Are you ready to talk about portfolio asset allocation?
Allocating assets is always a wonderful discussion.
So let's do it while we're sitting on our assets and having a little chat about portfolio asset allocation.
Let's do it.
You know, I have this funny shirt that says Sassy because the very first publication I was ever in was called Sassy magazine. And the irony is that my high school prophecy was modeling for Tiger Beat magazine. And Tiger Beat magazine and Sassy magazine are basically the same type of magazine for teenage girls.
Nice.
So that was what people expected of me coming out of high school. Look at me now, Mom. So the t-shirt says Sassy. And one day I just threw a blazer over the t-shirt. And I didn't look in the mirror after I threw the blazer over the t-shirt. And then a couple hours later, someone kind of taps me on the side and says, hey, Michael, you know the word ass is right in the middle of your chest? I was like, look down. I was like, oh my God, I'm really embarrassed right now. Clearly not so embarrassed that I won't talk about it on the air for thousands of people to listen to that slightly embarrassing, but hopefully slightly humorous story.
If we can't laugh at ourselves, who can we laugh
at? Yes. Well, actually, that's the problem. I think we laugh at other people more than we should, and we don't laugh at ourselves enough.
Yes.
So that's what we're doing here. We're just laughing all the way to the bank.
Yes.
So speaking of the bank, what is portfolio asset allocation?
Asset allocation is a very important concept when it comes to investing in the stock market to make sure you can allow yourself to be a good investor and taking emotion out of the equation. So it does a couple things for you. It allows you to get performance from a lot of different categories within the stock market. And then based on that allocation, so let's say you put 20% in 5 different categories, you let time pass. Some of those categories are going to make money. Some of those categories are going to lose money. And you want to find a system to continue to bring them back to that starting allocation. It forces you to be what I call a good investor. Selling high, you want to sell when you make money and then buy when you're down. You want to buy when something's low. So asset allocation gives you a process to make that happen automatically and taking emotion out of the equation.
Well, let's talk about emotion a little bit before we go on. How influential is emotion in somebody's ability to produce both short and long-term gains through any type of investment?
Emotion plays a gigantic role and often causes you to make bad decisions because emotions in investing are almost always opposite mentalities where you're thinking, when the market's charging and it's as high as it's ever been, everybody gets really gung-ho about putting in more money and doing more things. And again, there's no way to know for sure, but it might be the worst time if you're walking into a bear market. So you have to come up with a strategy and a process that takes as much emotion as possible out of the equation from an investing perspective.
Yeah, it sounds like you're talking about avoiding market timing in your investment decisions.
Yes.
Now, could you give a quick definition of market timing so people understand what that is if they're not familiar with it? And then I want to discuss where and for whom that type of driver is helpful and where and for whom market timing is actually really problematic and can get in your way of producing long-term gains.
Market timing is simply trying to figure out when the best time to buy or sell in the market is based on how you feel. Because we've been doing so well, I think the market's going to go down, so I'm going to sell out and go into a safer asset or cash asset. Or, I think the market's charging and I want to keep charging, so I want to put it in now because now's a good time. And it doesn't take into effect time horizon, goals, what your risk tolerance is. It's just, I'm thinking I'm going to outsmart the market. There's research upon research upon research that timing the market is impossible. And yes, you may get it right some of the time, but if you continue to do it, you're going to get burned by trying to time the market and get in and get out. You want to get into the market, figure out your allocation, figure out your risk, and make it a long-term decision.
We're not making our decisions based on external factors that are outside of our control that we can't predict. It's one thing to say, well, we should buy low and sell high, but of course, we don't really know where low and high is.
Correct.
So if we're not professional investors and we're investing for long-term security, for our retirement, as opposed to trying to make money this week and then live off that money like a day trader might, then we need to make sure that we have a philosophy that supports our investment activities.
Mm-hmm.
And also a way of avoiding getting carried away with the most recent news or the hot meme stock or whatever it is.
Buy the dip.
Yeah.
That's the big thing right now. Buy the dip. Buy the dip. The problem is you don't know how big the dip's going to be. And it's worked fairly well the last few years for people that are employing that strategy, but the dip may continue dipping one time you try to buy the dip, and then it's going to work against you. So short-term trading, short-term timing is really, really tough.
Matt, how about we discuss, and first define, of course, dollar cost averaging. Before we get into any more discussion around asset allocation or portfolio design, et cetera, let's talk about dollar cost averaging. Since the concept of market timing just came up, I think that's an important concept for everybody to understand if they are not yet familiar with it.
Yes, dollar cost averaging. And by nature, most people are doing dollar cost averaging if they're participating in an employer-sponsored retirement plan of some sort and they may not know it. Dollar cost averaging is simply putting systematically certain amounts of money over time into the various investments that you choose. So if, let's say you had a lump sum of cash, $100,000, and you were like, I want to invest this money. You have the choice of putting all $100,000 to work immediately, or say taking 5 months or 4 months to put $25,000 at a time strategically into those same investments over time so that you may benefit, hopefully, from the volatility or swings in the market over those 4 months versus taking on the risk 100% right at day one.
So for most people who are looking at long-term investing, and that's going to be most of the people who are listening to this show. And in fact, that's what we're focused on this season.
Yes.
Long-term approach to building your wealth and preparing yourself for whatever your version of retirement is. Most people should be doing that. I definitely do that. What if somebody has a big chunk of change that they finished a big contract and they've got a big chunk of change, or maybe they just inherited a little bit of money or they sold a property, et cetera. Let's just say it's $100,000. Should they take that and dollar cost average it out over the course of, say, a year, which again would just be an arbitrary amount of time? Or should they take it and contribute to their investment vehicles based on the same philosophy that they would if they were dollar cost averaging? Do you have a perspective of one over the other?
The timing of how long you dollar cost average over is a little bit of a personal decision. At a minimum, if you're going to dollar cost average, I would do at least 3 months. The intent of dollar cost averaging is to take the swings of the market and reduce your risk. The correction commentary happens once a year. So people talk about a stock market correction like a birthday. At least once a year, you should expect, if you're in stock market-based investments, that you're going to see a dip of at least 10%. That's kind of the way to remember a correction. 10% isn't necessarily a bear market. It's just a downturn in the market of 10%. Well, what happens if you put that 100,000 in and you walked right into that correction? You're going to lose $10,000 immediately. If you took 3 months to take $33,000 a month and you walked into the correction, well, round two of that investment is going to buy at that 10% lesser value to give you better cost on your long-term performance. So 3 months is a minimum. 6 months is probably the most common for a length of time for dollar cost averaging. 12 months might be a little long. Just depends on the amount of money and the potential downside you want to avoid. So if it's a bigger pot of money and you're worried about a 20 or 30% decline, you may want to take more time to do a dollar cost averaging strategy.
Okay, so I take a slightly different approach because anytime I have a larger sum that I want to invest, I always put it into the portfolio in the same allocation that I have for everything else to keep balanced in the way that I've determined is best for us now and going into the future. Because I don't know what's going to happen next month or the month after the month after. It could drop 10% today and go up 11% tomorrow. We don't usually see those kinds of swings in a broad-based index fund, but you certainly would see it in a stock, in a particular stock.
Sure.
But that's a lot of volatility. For example, small cap stocks, the index, I think it's the Russell 2000, just recently, over the course of just a few days, dropped over 10%. I think it was 11.47 or something like that. And that's correction territory for one asset class in the total stock market. So I don't know, is it going to go down more the next day or the next week? Or I don't know if it's going to go up. So I just figure I want to get in as early as possible and then ride for the long term off into the sunset, because I don't want to even begin to start trying to make assumptions about what might or might not happen with the stock market. I just know that over the long term, and since I'm looking long-term horizon, if it drops 2 days after I put it in, I'll make that up in a number of years. I'm not looking for the return right away. So what do you think about that particular approach?
That ties right back to the emotional component of it. And you always have to factor in what you're going to think and feel emotionally when you're making those decisions. You shouldn't be worried about that short-term dip if you're a long-term investor. But what it does is it tends to spook people. If they make a full investment right away and the market trends downward right after they did it, then they start to question their long-term strategy. And that's the one thing you don't want to do. Additionally, we often talk about dollar cost averaging on a month-to-month basis, but you could also dollar cost average weekly.
Yeah.
In recent times, we've had lots of market volatility, movements up, movements down. You could get a lot of benefit just doing a weekly dollar cost averaging to say, hey, every Wednesday, we're going to start to deploy a portion of this capital until it's fully invested into our original intended allocation.
Yeah.
That's the goal, is to get to that allocation as quick as possible and let the investments do what they do over the long term.
Yeah. Plus, if I had, let's say I had $100,000 that I wanted to invest, if I don't put it all in the market right now and I just sit on the cash, let's say I decide to dollar cost average it out over the course of a year, and well, let's just say it's $120,000 to make it easy. So if it was, $10,000 a month throughout the whole year, if we keep seeing an environment of high inflation, that money is losing money. That cash is becoming less valuable. If we see another 5% or 10% inflation, that cash will have less buying power by the end of that period of dollar cost averaging. So in an environment of high inflation, do you think it makes more sense to make that larger contribution as soon as you have the money?
I would probably never go over 6 months on a dollar cost averaging strategy, because you might miss the best part of the market. And again, if then you came into a bear market after that happens, you're going to feel more of that, and it takes a little bit longer to recover. So 6 months would certainly be my longest. And then again, I would probably opt for a weekly type of strategy inside of a 3 or 6 month period.
Yeah, it seems like many of us do dollar cost averaging in part simply because we don't have all that money at once. We're getting it on some sort of regular frequency. Either it's because we take profits from our business every quarter, so you're getting it quarterly, so every 3 months, or you're getting a paycheck every 2 weeks. And so, you're contributing to your retirement accounts or your brokerage accounts every 2 weeks because that's when you get it. Or you get it every 2 weeks, but then you just do it at the end of the month. So sometimes it's just by default because we don't have the money yet.
Yeah.
That's how most of us will approach it. And it's a reasonable strategy. And I think that it's just important that we just don't hold back and hold on to it, worry that the market's going to go down right now if it's not money that we are going to use in the short term. And if we do need the money in the short term, we probably shouldn't be putting it into equities in the stock market. Would you agree?
Correct. Yeah. You want to make sure you've got your access to capital formula and your long-term formula figured out. And if this is money in that long-term bucket, you want to find out how to get it deployed for a long-term result as quick as possible.
I'm going to ask you one of those really dumb questions, which is who should be thinking about asset allocation or portfolio asset allocation? Meaning, is this for everyone or is it just for some people?
It's really for everyone. And I highly encourage you, if you have retirement accounts or other investment accounts, to make sure you understand what the asset allocation is, especially in times, as we record here today and where the market's at currently. What often will happen, or I'll refer back to, say, a year 2000 or year 2008 downturn, when asset allocation is so detrimental is after a run-up in the stock market and people haven't been disciplined to go back to their original percentages. So let's say I only want 60% in stocks. And when I make that initial decision, stocks just continue to grow and grow and grow. And my 60% stock allocation becomes, say, 80 or 85 because there's been so much growth. Well, then we walk into a bear market. If you haven't gone back down to your 60% allocation, now 85% of your money is subject to the stock downturn. And that's what you don't want. So without doing proper asset allocation, you're exposing yourself to risk that you may not realize. Mm-hmm. The other thing we see a lot too is you do what your friend does or do what your neighbor does. So a lot of, especially retirement plans specifically, they will give you funds that will do some of this asset allocation for you if you don't want to get into the weeds and figure it out. But you want to at least know, I have my asset allocation handled and understood in some capacity so that you don't wake up with a shock if we have a bad bear market.
Yeah, actually, in my case, I probably should do what my neighbor is doing because my neighbor just sold a business for $30 million.
Nice.
So I'm going to try to do that as well. If anybody would like to offer me $30 million for heroic public speaking, I'll pretend that I don't want to sell it, but I'm happy to sell it to you for $30 million.
Nice.
But anything less than $30 million, no way. Okay. So you touched on rebalancing, actually, when you mentioned, well, if you believe that your portfolio asset allocation should be 80% stocks, 20% bonds, or 75% stocks and 25% bonds, or 60% stocks and 40% bonds. I'm going to get into that in a minute and then discuss recommended portfolio asset allocation for different types of folks. But before we do, I just want to ask you to touch on the various dynamics of portfolio asset allocation, because I've heard you talk about two different dynamics that we should consider when we're thinking about portfolio asset allocation.
Yes, a lot of what we've talked about so far is strictly related to the stock market. You also can have asset allocation just as a percentage of your wealth goals and your net worth. What do I have in stocks? What do I have in small business? What do I have in real estate? What do I have in crypto? All these different categories, you want to be thinking about those target allocations as well, because as the world gets more connected and more technologically advanced, you want to understand how to continue to diversify types of assets in case the stock market doesn't produce at as high of a level going forward. Some of the people out there right now are predicting that returns might be less the next 10 years. Well, how do you continue to make sure you're keeping up with inflation? You have other types of assets as well. And those are just a few of the other asset allocation things you can think about from just your personal net worth and other assets beyond the stock market.
So dynamic one would be from a pure stock market investment perspective across all assets that you own in your portfolio that's exposed to stocks and bonds, I suppose.
Yeah. Do I have small, medium, and large companies, different variations of bonds? What do my allocations to all of those want to be? Yeah. And make sure that I start with a number, let them do their thing, and then rebalance back to a number.
Right. So that's basically stock and bond market investing.
Yep.
And we're going to get into a little bit more detail about that shortly. And then the second dynamic sounds like asset allocation on percentages of your net worth. So you're looking more holistically at your financial position or situation, your estate, your net worth, whichever term helps you see the big picture, the 30,000-foot view. And so you're taking into account all of the different types of assets you either own outright or own with some liability, some debt associated with it. I use the word liability because we did an episode on, liabilities versus debts. Mm-hmm. I take the second approach. I'm assuming you do too.
Yes. Well, we touched on this in a previous episode, but if your personal net worth asset allocation has your primary asset 80% as your business and only 20% to other assets, and then you don't sell your business for what you hope when you're ready to retire, your retirement could be very different than you had hoped.
Yeah.
And so that's where that dynamic number 2 really helps you get a safer ground around, hey, what if something doesn't pan out as I thought? I've got other assets to keep me on track with the eventual goal of where I want to be later in life.
Yeah. Like, for example, let's say somebody invests in real estate. They buy houses and they rent them out.
Mm-hmm.
So somebody's been doing that for a number of years, and let's say they've got 7 or 10 properties. Well, they've got a lot of their overall portfolio invested in real estate because they've put a lot of money into these properties. And then if in their stock market portfolio, they bought a lot of REITs, real estate investment trusts, well, then they might be really overweighted in real estate. And as a result, if a real estate market correction or crash of some kind occurs, they're much more exposed because they're overly weighted in that particular asset class, whether it's in stocks, in some sort of a fund that buys different real estate investments or different real estate company stocks, or whether they just own their own property or multiple properties that they use for business purposes.
Yeah, I love that example because that's where you have 2 very different types of real estate assets. One that's stock market focused and offered to multiple investors, and then you're maybe individually investing in real estate. And if you don't track that, you may realize, hey, I'm overweighted there and I don't want to be, because if something goes wrong in real estate, it could hurt me way more than I expect.
Or another example might be, very often investment advisors will suggest that people hold in their portfolio a percentage of international stocks. So if they're recommending, someone buy an index fund, and again, we'll get more into this soon, they're recommending, listen, we think you should have a portfolio that's 60% stocks, 40% bonds. And we want 40% of the stocks to be international stocks. So we're going to recommend you buy the, Total World Index Fund or Total International Index Fund. But actually, they would own a lot more than 40% of the international or the European market or whichever index they're buying, because most of the top 10 biggest companies in America do sometimes the majority of their business overseas. So even if you're buying very large U.S. companies, you have exposure to international markets because their revenue, their success is in large part dependent on what's happening in the European economies that they're in.
Yeah, I think when it comes to foreign versus domestic investments today, you've got to really open your eyes around what impact that has on your asset allocation, because it's a global economy today.
Yeah.
Used to be much different even 20, 25 years ago, saying I'm allocating to US and I'm allocating to international. We weren't as connected because the internet wasn't charging like it is today and didn't have all of us doing business so easily as it is done online. So you definitely want to open your eyes to that for sure.
Great. And so in a minute, we're going to go into the different types of asset classes you could buy in the stock market and in the bond market. And then we're going to ask Matt about what he recommends for portfolio design for a number of different types of people, because I think that you'll see yourself in at least one of those examples. But before we do, I just want to take a quick break to say that this episode of Steal the Show with Michael Port, and I am Michael Port, is brought to you by HPS Grad, one of the signature programs at my company, Heroic Public Speaking. And I think it's fair to say HPS Grad is the most substantial and complete public speaker training in the world. It's like a graduate program for the world's most transformational speakers. Now, maybe you're ready to start delivering more compelling performances every time you step on the stage. Or maybe you want to increase your speaker's fee. Or maybe you need a proven, repeatable process for developing and rehearsing your content. In HPS Grad, our students learn how to do all of that and much, much more. HPS Grad is an intensive program broken into 2 terms, consisting of both in-person and virtual learning experiences. Students are immersed in rigorous speech writing and performance training, and they get to know us and our team, form long-lasting friendships with one another, and completely transform their speaking and performance abilities. Now, HBS Grad is only open to students who've previously completed our free training program, HBS Core. And to learn more about HBS Core and HBS Grad, visit heroicpublicspeaking.com. If you want to learn just about grad, go to heroicpublicspeaking.com/grad-school. That's heroicpublicspeaking.com/grad-school. Okay, Matt, let's talk about different types of asset classes in the stock market and in the bond market. Now, we could do that for the next week because you can keep slicing and dicing
Yes.
into smaller and smaller asset classes, but let's just hit the general ones. And then let's talk about some typical effective portfolio design options for our listeners.
Yes.
So what are the primary asset classes in the U.S. stock market?
The primary asset classes there, you've got large cap, mid cap, small cap, and then you've got a lot of variation inside of there.
Before we go to the variation on large, mid, and small cap, let's define cap.
Yeah.
Capitalization, capitalized. Because I remember the first time I started looking at the market, I was like, what is all this cap? And now the kids use the word cap. Do you know that?
I didn't know that yet.
Yeah. Like if they say something and someone else is like, for real? Like, really? That happened? They're like, yeah, no cap. I think. Although every time I try to explain one of their expressions that they've explained to me, I murder it. I do it terribly. We're not using it in the way that the kids are using it. What does large, mid, or small cap mean in the U.S. stock market?
Capitalization represents like what size and how much dollars are represented in the overall marketplace. You may have heard recently some of the cap goals or cap targets that some of the really big boys have hit, $1 trillion market capitalization, meaning between all the shareholders and assets and valuations of the company. I don't know if it was Apple who was first.
Yeah, I think it was Apple.
But we hit $1 trillion valuations in terms of market cap. So it represents the size. So large cap is your very big market capitalization. Mid cap are your medium. So they're kind of middle of the road, but certainly sizable companies, but they don't really operate in the same categories as the large ones. And then the small ones are the growth ones. The way I like to explain those is they're trying to become mid and large. They want to get in there. Their whole focus is growth, growth, growth. That's what small cap is really doing. Hey, we're starting out. We think we've got a great idea and we want to grow as fast as possible.
Now, isn't that a little tricky, though, to use the word growth for the small cap companies? Because when we start slicing down into more sort of segregated asset classes, we have growth versus value in each of the different market capitalization companies. Typically, some of the assets that will offer the biggest returns for you over long periods of time are small cap value funds or stocks, individual stocks, because they're often undervalued. Like the price is lower than it might be for the value that company is going to produce. I don't know if that's the right way of defining it. Again, this is not my area of expertise. But I know that we break down these different capitalization companies into growth and value. So how should we think about those types of breakdowns as well when we're thinking about asset classes?
Yes. Growth versus value is really thought of. Growth, pretty self-explanatory. I want to see the price or the company grow, hopefully as fast as possible. Value is going to be more of the way I define it, a consistency level. I want to come in, if I'm doing a large cap value, I might be looking for a dividend or steady performance or just, more consistency out of that large company versus a large company that's trying to grow, maybe a lot more volatile, up and down. So that's how I look at growth versus value. And then when you get into the mid and the smalls, you have to really look at, again, bargain shopping. A mid-cap value, they may be undervalued because maybe everybody doesn't know about them yet, or maybe they have a new product that they're going to launch and that's going to take them into more of a growth category. But consistency versus growth is really how I break those two down.
So, okay, now what about in the bond market? What are the various asset classes or the highest level segmented asset classes in the bond market for fixed income vehicles?
Fixed income, often referred to as bonds. The bond market is just as complex and vast as the stock side of the equation. A bond, by definition, is just a debt instrument where a company needs to raise some capital, so they offer a bond out to a purchaser. And that purchaser gives them the money, and in exchange for that money, they give them an interest rate and an income stream, so to speak. So there's all different grades of bonds from all different sizes of companies. There's something you may have heard called junk bonds. You really have to do some research around the types of bonds you may be in. If you're buying individual bonds, you want to be very aware of what that is. They're all going to pay different interest rates. You also have government bonds, municipal bonds. Municipal bonds are more local, state and government type bonds. So very, very complex. Don't let it overwhelm you. I say it's complex, but don't let that stop you from learning about how some of those things work. What are the pros and cons? The simplicity of a bond is that it typically pays interest 2 to 4 times a year based on how the offering is written. And then the government, you may hear government bonds talked about a lot on TV or in other various internet spaces, because a lot of the things we deal with in life are based on government bonds, like mortgages, for example. There's indexes and treasury rates and all these things that govern how much mortgage rates go up and how much mortgage rates go down. That's all based on the issuance of bonds and people buying those bonds and earning those interest rates.
Yeah, I've always found bonds a bit confusing.
Mm-hmm.
You've got this yield and then the interest rate, and sometimes when one goes up, the other goes down, and it's confusing which is which.
Mm-hmm.
So I don't buy any individual bonds, period. The only individual bond we own is a $250 bond that my grandmother, who passed away at 103 years old, gave to Jake when he was born.
Yeah.
And that just sits in the safe, and it has like a gazillion years before maturity. So we'll see what that does. But, I just buy index funds. I buy all the bonds that are out there, and we'll get into that in a minute. The thing that really helped me understand bonds, just from like the basic, simple, even a 5-year-old could understand it, is that sometimes governments and companies need money to do the stuff they want to do. And sometimes companies will go to investors to try to raise that money. But, governments don't really go to invest in our company. Like, it doesn't work that way.
Mm-hmm.
So the federal government, state government, when they need money, they'll issue a bond. We're essentially loaning them the money, and they're saying, look, I'll give you this guaranteed interest rate on this loan for a period of time. And same thing with the companies. But, you have companies that are of different sizes, different strengths. So it's really tricky when you start buying individual company bonds,
mm-hmm.
because if you don't really know what you're doing, you can end up buying a bond for a company that's not here in 6 months.
Yeah, credit worthiness and strength of company are extremely important with bonds. So think about COVID for a second and think about the airline industry. You could have gone out and bought some individual bonds from some airline companies that were paying you 8, 9, 10, 11, 12% interest. Really attractive interest rate, but what if they file bankruptcy? Then you got to worry about, am I going to get paid at all? Not just my interest, but my original principal. That's really the risk from a credit worthiness perspective on bonds, that if you're buying an individual bond, you absolutely want to understand those things. Bond funds and bond indexes help you mitigate some of that risk because you're pooling lots and lots of different bonds together, so that if one of those bonds goes belly up or one of those companies goes belly up, you're not fully taking on that risk to your own assets.
Perfect transition, Matthew. Thank you so much. Because what I wanted to talk about was the different types of vehicles you can invest in. People hear index fund, then they hear mutual fund, then they hear individual stock, individual bond, bond fund.
ETF.
Yeah, ETF, right? An exchange traded fund or a fund of funds. Forget about it. Right now you're all over the place.
Mm-hmm.
Then they hear hedge fund and they're like, well, should I be in a hedge fund? The answer is no. Unless you've got a family office, maybe, and then you're like, I don't know what to do with this extra $8 billion. Maybe I'll give it to this guy in his fund and see if he can do something. But the rest of us, probably not. So let's start with the difference between an index fund and a mutual fund.
Yes. So a mutual fund is probably the longest running fund type of category that you've maybe heard of. And a mutual fund is a pool of investments inside of a corporation. This was very popular and started a lot back in the 70s and 80s when you couldn't buy stocks online. You had to go to a broker. It was very hard to get investments into the stock market without going through the Wall Street channels. And then on top of that, you had to buy individual stocks if you were doing that. And that tended to be very risky for folks because one individual stock can go up and down in value way faster than a pool of stocks together. So this mutual fund concept was born. And then you could own many, many different stocks inside of this corporation. And then you as the investor own a share of the corporation or the mutual fund. So it's mutually together and you have a small percentage of the fund. That also is why mutual funds trade in terms of their price at the end of day value from the market. You can't day trade mutual funds. Mutual funds have a lot of inner workings and reporting, and they price out at the end of each day. And then that corporation, like American funds would be one, Vanguard, there's all kinds of mutual funds out there, but there's fund managers then buying all those stocks, and you're just buying a share of what that corporation is producing.
Now, we should make a distinction between passively managed index fund and an actively managed mutual fund.
Mm-hmm.
It's a little confusing because an index fund is still a mutual fund. It is a fund made up of many different stocks or bonds, depending on what kind of fund it is, or both. So can you define a passively managed index fund versus an actively managed mutual fund?
Absolutely. The passively managed indexed fund is really already using indexes that exist. So groups of companies that are pooled together. So the easiest reference that maybe everyone can relate to is either like the Dow Jones index or the S&P 500 index. That's all predetermined. So the index fund only has to go in and pool those indexes together, which can keep their costs very, very low.
So for example, Vanguard, as well as most other companies, although Vanguard is my favorite company in the world because it's a not-for-profit, and Vanguard and John Bogle changed the world for individual investors. The reason that most index funds and mutual fund prices have been going down over the years, in large part because Vanguard is pushing those prices down for many, many years, and people have had to keep up. So that's wonderful. But, there's the S&P 500, which is an index. And it's just saying, look, here are the 500 biggest companies on the U.S. stock exchange. You could put together a fund of those 500 and call it, say, the Vanguard S&P 500 fund. And they are only buying the companies for you based on how much you buy into this fund that are in that index, and they distribute your purchase evenly across the index. Is that accurate? Do you think that's a reasonable description?
Yeah, absolutely.
And the same thing is true for, say, the Russell 2000. That is a small cap index. It has many more companies than the S&P 500 in it. They may put together an index fund that is a small cap index fund, and it buys all the companies that are considered small cap companies in the U.S. stock market. And, they may just say, well, we're going to slice that even further and make an index fund that is a small cap value fund. So it's only buying the companies that are considered value companies versus growth companies. But nobody is picking winners or losers.
Mm-hmm.
The managers are only buying the index that they are tracking. You're not hoping that this one person who manages this fund is going to have the ability to predict the future and is not buying or selling what they think is going to be winners and losers. Instead, you're just tracking the market. Whatever the market gets, you get. Although, even people who just buy passively managed index funds, even when they have a reasonable portfolio, stock to bond, asset allocation ratio, they will often underperform the market because they market time.
Yeah.
So they won't actually get the full performance of the market because they're buying when they probably shouldn't be buying, and they're selling when they probably shouldn't be selling because they're emotionally driven and they're getting out when things get a little scary, and they end up selling at a loss, or they get in at the wrong time because everybody's hyping it up. So they buy at a premium, and then it takes a lot longer to recover or to earn gains on that because they bought at a premium. So when you're in index funds, you generally want to sit and wait it all out until you're going to need it. And then we'll talk more about actual retirement strategies. And we did an episode where we talk about bucket strategies in retirement and what to do with that money that you've amassed over the years when it's time to start actually accessing it. But in this case, I just think it's important to remember that you still have to get out of your own way,
Mm-hmm.
even if you're taking the passively managed index fund route. Now, Matt, can you explain mutual funds, how they work, and also what the track record is for most mutual funds?
An actively managed mutual fund involves money managers. It involves a main company that's running the mutual fund, and it involves a lot of discretion. So the discretion comes to what stocks and bonds do we buy, if it's buying bonds or if it's only buying stocks. Like a growth mutual fund might only buy stocks, but you're leaving all of the decisions up to the money managers. And then on top of that, because the mutual fund has to employ money managers. They have to file a lot more compliance-related items. They have income distributions kicking out on an annual basis, whether you want them to or not, especially if it's in a taxable account. What tends to happen is mutual fund expenses run a lot higher than an index fund or ETFs or other things that are basing them on just a strategy or a system or a process. So that's then been the trend the last 20 to 30 years, is really examining what are the true costs of a mutual fund and making sure that if you're going into those mutual funds, they're delivering you enough return to outweigh the cost that mutual fund is charging. Or if not, you may want to consider an indexed or a more passive strategy with much lower cost and systematic rebalancing. So that's the type of analysis you want to think about.
Okay, I'm going to hop up on another soapbox because I have some cynicism about many of the mutual funds that are offered in the U.S. I'm sure around the world, but I only know this market. I have a lot of friends who are mutual fund managers, so no, but I do. One of my closest friends is an analyst at one of the biggest funds in the world, actually. And I was telling him about all my cynicism and why I think most mutual funds are actually created. And he's like, you're insulting me and everybody who does what I do. And I was like, well, yeah, I guess I am. But I don't mean to insult you specifically. And I just say that just to preface it. I don't think all mutual fund managers are bad at their jobs. I think there's a lot of really smart, well-educated people who are in that field, and they're often good people who really do believe that they can beat the market and want to provide a great return for their investors. I think there are many, many people like that. Whether they can or can't actually doesn't matter, meaning they might have the best of intentions, but it doesn't mean that they're going to beat the market. Or if they went to Wharton or Harvard Business School, it doesn't mean that they're going to beat the market. Or if they have a very expensive suit, doesn't mean they're going to beat the market. But here's my cynical theory. I think many mutual funds are established to look sexy and really provide income for the fund managers, the institution that is carrying this fund, through the fees that they charge, because they earn fees regardless of whether or not the fund does well. Mm-hmm. So I have a friend who is one of the partners and founders of a hedge fund. And one of the things that's cool about his hedge fund is that they only take a small percentage of the return unless it's above a certain percentage. So the fund has to make a certain percent in annual return for them to get their big money. Mm-hmm. And at that point you go, okay, great, because there's some pretty aggressive goals there. But for most funds, it doesn't work like that. John Bogle, one of the things he said, and I'll paraphrase, is he said the biggest risk to the individual investor is the tyranny of fees. Mm-hmm. And the more you pay, the less you get. Generally, when it comes to stock market and bond market investing. So let's get into that a little bit now before we talk about recommended portfolio design, because I think it's important that people understand how they pay for these types of investments, mm-hmm. and what's inexpensive and worth it and what's expensive and not worth it.
Yeah.
So, Matt, can you just talk a little bit about what the general fees are for, say, a Vanguard total U.S. stock market fund, which would have all the stocks in the whole U.S. market in one fund, or an S&P 500 fund, which is just the top 500? How do the fees generally work for, say, a Vanguard fund like that?
Fee warfare has existed for a long time, and now, thankfully, it's just becoming more transparent and people are becoming more aware. And that's been the warfare on Wall Street. It's a disclosure game. They've had to disclose certain things, but then you can find out more later, and it's just a legal war at that point. So lower fees are always better for your performance. If you're going to pay higher fees, you better make sure you're getting higher performance. But we as Americans and humans, what we typically do when we're paying a higher fee, we pay the higher fee and then we don't monitor, we don't check, we don't look at it. And then that's where the fee can erode your return significantly over the long term. So like the hedge fund guys, the 2 and 20s, you may have heard that, 2% fee and a 20% of profit. That's a pretty big fee. So if you're paying something like that, you better be getting a return that justifies it, or you're losing a lot of your money unintentionally. So on the fee side for like Vanguard or indexes or ETFs, you're looking at the lowest cost options on the market. You may pay anywhere from, I'm going to use a basis point reference, 5 basis points to 15 basis points. So what that means is 0.05% is 5 basis points, or 0.15% is 15 basis points. Those are some of the lowest cost products you can find on the market.
And a basis point, Matt, could you just describe like how many pennies in $100 is 5 basis points?
Yeah, 5 pennies. 100 basis points is 1% or 100 pennies. Like that's the way to think about it. If you've never dealt in the basis point conversation like that, it gets confusing at the start, but the penny reference is a good one. It's basically 1 penny per basis point. 100 basis points is 1%. So that's just how you kind of do that math.
So think about how this plays out over a lifetime of investing. Say, if you get a total stock market ETF from Vanguard, an ETF is an exchange-traded fund. They're made up the way index funds are made up on the exchange, and you can trade them at any point throughout the day when the market's open. They're essentially the same type of investment. So you can get it for 0.04% or even 0.03% if you're in one of the institutional ones. So that's 3 pennies out of every $100 that you put in there. That's what you're paying, 3 pennies for every $100. Okay, now imagine it was the same fund, but you were paying, say, 1.5% to the advisor who is managing it. And we did a whole episode where we talked about advisors, the good, the bad, and the ugly, that sometimes advisors can be really helpful because they can keep you on track, and maybe that money is worth being spent if it's spent in a way that's reasonable. But then other times where the advisor is going to charge you a lot of money and not really pay attention to what's happening, or actually put you into investments that are going to lose to the market over time.
And if they're charging you a fee, what are you supposed to be getting? Is it just investment management, or are there other services in there? Make sure you're clear on that. Again, ask those questions.
Yeah. So if you're paying 1.5% to the advisor, and that's 1.5% of all of the assets that they have under management that are yours. So if you give them $1 million, it's 1.5% of $1 million. If then the funds that you're in are another 1% expense ratio, now you're paying 100 basis points for the mutual fund. And then many mutual funds still have a load at the beginning. A load is a fee that you're charged when you make an investment into the fund. And many of them have stopped doing that because it's been harder for them to get away with it. But there are still funds that do it. And so maybe you're paying 5% on the front end of what you put in. Now, let's just say you didn't have a load, but there was 1% expense ratio on a mutual fund. But actually, there are additional costs that the mutual fund incurs that are hard to see, that are not particularly transparent, but could add up potentially to another 1%. Internal fees, trading fees, document fees, all sorts of things that they will tack on. So now, let's just say you're spending 2% to be in that mutual fund, and you're giving the advisor 1.5%. So now you're at 3.5% that's coming off the top.
Yeah.
So let's just make it the math easier for me. Just make it 3%. So if the market returns 10% and your mutual fund returns 10%, you have to pay 3%, 300 basis points for the privilege of being in that mutual fund versus, say, 3 or 4 basis points for being in an index fund that's actually capturing the same amount of growth, but actually you're getting more value in the return because you get that additional 3% or almost additional 3% that you've got to pay to somebody else to get the same returns. Now, it gets worse if the mutual fund underperforms the market. So the market brings 10%, then your mutual fund has a return at the end of the year of 7%, and it costs you 3%. Well, now you only made 4%, and you were in a risky investment where you could have been in a bond that was much more secure, making 4%. So that's why I am the biggest fan of passively managed, inexpensive index funds. Yes, there is absolute value to actively managed funds for some people in the right circumstances. And there are a few people who over a decade or so continue to produce big results in mutual funds, but we don't know if they can do it for 30, 50 years.
Or how involved are you going to be as the investor in looking at and monitoring your stuff? Your example you just gave, that mutual fund has to perform 13% return, 3% higher than the market just to be on the same level. So if you know you're paying those extra fees, you better make sure and have the wherewithal to compare it to what a passive index type investment would be and beat that benchmark. And if you're not beating that benchmark, then you probably shouldn't be in that fund. Now, also, you have to take the time to compare it to the benchmark and most people don't get that involved in their finances. So you just want to be aware of what's going to work best for you and how involved you're going to be. And then how do you compare things easily?
Yeah. And how do you reduce stress around this? How do you make it as easy as possible as worry-free as possible so that you know what your long-term goal is, you know exactly what you're paying, you know how it operates, and you can just go about the rest of your life and focus on the stuff that's really exciting to you. I think that if you're trying to outperform the market and thinking that you're smarter or that you've picked an investment manager who's smarter, then you're always going to be at risk of being fooled. You're like, oh, I was wrong. I thought this guy was the best.
Or changing accounts or advisors on a regular basis, and then you may come out of the market and miss some of the market when you're making the change. And there's all those little risks of just not picking a strategy, making it simple, and sticking with it.
If you start with mutual fund investments or individual stock investments, well, and you do get some gain from them over a number of years. If you realize, oh, I want to take a different approach and move into index funds, well, you have to sell all those investments, which means you're going to incur capital gains taxes, most likely. And if they're short-term gains, you're going to incur high taxes because you're not going to get the long-term rate. You'll get the short-term capital gains rate. So I think there's just a lot more risk in trying to beat the market than get the average returns. Because I think when people hear average, especially the kind of people that listen to our show who are ambitious, who like to be the best at what they do, they think average. I don't want to be average. Average is for someone else. I want to maximize everything. Trust me, I am a maximizer. Ask my team. I always want everything to be the best. I want HPS to be the best, like everything. But I realized over time, average means the best for someone like me in the market. Meaning, if approximately 85% of mutual funds cannot outperform the market each year, 85% of mutual funds on average do not beat market returns, that means I'd have to be clever enough to pick the only 15% who made returns that year and then know who's going to make them the next year and the next year and the next year. Because past performance does not equal future performance. Just because someone, did well last year doesn't mean it's going to happen the next year.
And along the lines of performance, the best thing you can do for your retirement is save a lot. People chase performance because they're not saving enough. They're not setting aside, you've got to allocate between saving and investing, but the more money out of your income that you can set aside into your strategy, the more safe and secure you're likely going to be long-term. People are chasing return because they're not putting enough money aside. They're spending too much of what they're earning. And that's the most powerful thing that you can do. And then when you realize that you're saving and putting money aside at a high rate, then you don't have to worry about beating the market because you're giving yourself the best boost that you can.
Yeah, and you can also continuously buy and keep putting more money into the market to get those gains over time that the market has consistently produced. So advisors often talk about what percentage of your income you should be putting aside for quote unquote retirement. And usually they say 10%, but that seems woefully insufficient in this day and age, especially if people are starting late.
Yeah, the later you start, the bigger the number. Think about that. I save 10% or set aside 10% of my income to provide 100% of my retirement. How does 10% become 100%? So you want that number to be as big as possible. Now, if you haven't started saving, you can start at 10%, but try to ramp it up. You want to ramp up that number you're setting aside as fast as possible. Get your lifestyle to where you want. But everything you start to earn over and above where your current lifestyle is, don't let lifestyle creep happen. Let that money go into your savings and investing strategies because that's going to be your most powerful asset.
I've been drilling into my kids, which probably means they won't listen to me. But I've been drilling into my kids for as long as I can remember that as soon as they start earning money, out of school, they earn a little money now at their jobs and they have investment accounts already. But when they are making an income, that is a full-time income after school, I really hope they put 50% of their income away starting from day one.
Yeah.
And you might think that's a huge number. Like if they get a job that's say 50 grand a year, they're going to live on 25 grand. Yeah. When you're 21 years old, you can figure out a way to do that. You get a place with a couple friends, you share rides, you don't buy some fancy souped up car that you can't afford. And then by the time you're 30, you'll have enough money in there to be able to choose the kind of jobs you want and pass on the ones you don't want. It just gives you so much more choice. And I did not do this when I was younger. And I look back and I think, holy cow. When I was an actor, certainly in my early 20s, I didn't have much money, but I still could have put money away. I mean, I made enough money that I could have put money away instead of, wasting it on some of the things that I did. I think, man, if I had started back then, holy cow. Because time is the greatest asset you have when you're trying to produce returns from almost any asset class in the market.
Mm-hmm.
So let's talk about a recommended portfolio as our last section here. For a speaker who, is making a good living speaking, maybe they're not super famous yet, so they're not pulling in crazy fees, but, they're making some money. They've got enough to save. Maybe they're able to put away 15%, 20%, and they say that they're in their 40s, maybe late 30s. How do you generally recommend somebody sets up a portfolio for themselves if they're doing it for long-term returns and their retirement needs?
Yes. At the 30 to 40 range, your time horizon is 10 years plus. My general advice is to try and take as an aggressive of an approach on the portfolio as you can stomach. And talking through that too is key at the beginning. Let's use an 80-20 reference, 80% stocks, 20% bonds. You can go in there and have a small portion to fixed income. What that allows you to do, if you're not adding large amounts of money to the account, when the market fluctuates up and down, that's when you have to buy some of the bonds and sell some of the stocks, and vice versa when the market's fluctuating. So an aggressive portfolio at that age is certainly warranted, in my opinion, unless they're going to make bad emotional decisions. Some of that's talking through it with the client to say, hey, what are you going to do if the market goes down 30%? Having that conversation at the beginning is really the biggest part. That's where most people make bad emotional decisions, is nobody talked about the bear market part of the conversation, because the bear market is certainly the minimal part. It's typically 3 out of 10 years where we have bad market cycles. So 7 out of 10 years, it's pretty easy to manage the account. So you don't have to worry about that allocation as much from an emotional perspective. But I would say at least 80-20. And then if they are comfortable with that risk, you could even go 100% stocks. And then as you're adding more money to the account, figure out the allocation as time passes.
I keep an 80-20 portfolio, 80% stocks and 20% bonds. I also keep a fair bit in cash as well, just in an emergency account. But there's a difference between emergency savings, savings for a purchase, and investing.
Mm-hmm.
We addressed this in earlier episodes, but it's important that people first have an emergency account that they can get quick access to cash if they need it for whatever reason.
Yeah, access to capital.
Access to capital. And then you might say, listen, we're saving for a house. We want to buy a house. Well, you're not going to take that money and plop it into a 100% stock market fund because that could drop 30% in a month or so. Then you don't have access to that capital because you don't want to sell it at such a loss. And it's just kind of tied up. It's relatively illiquid in that way. So then you might say, okay, we're going to save money here for that particular purchase. That's important to us. But then your investing is going into the market. It's going into buying real estate, if that's something you want to do, or it's going into whatever other type of investment you think is in line with your particular philosophy and your goals. So let's talk about what you buy inside that portfolio allocation. I mean, whether it's 75 or 80% stocks and 20 or 25% bonds, or 60-40 if you wanted to be more conservative. That's really not a big deal. If it's 80 versus 70, better to save and get it in there than obsess on, these small differences in your portfolio. But then you're just trying to keep it balanced so that it always stays at that particular ratio.
Mm-hmm.
So if stocks shoot up and my portfolio changes so that it's now 85% stocks and it's 15% bonds, well, I'm going to do one of two things. Either my next contribution is going to buy bonds to try to increase my share of bonds. So essentially I'm using my contributions to balance the portfolio.
Mm-hmm.
Or I'm selling some of my stocks and moving it into the bond funds. And I don't want to do this in taxable accounts, but I do that in tax-deferred or tax-free accounts because there's no tax implications for selling and keeping it in those accounts, if you're just moving it from one fund to another inside those accounts. But let's talk about what you buy. For me, I keep it really simple. I buy total U.S. stock market fund at Vanguard, and I own all the stocks in the U.S. stock market. I also buy the total U.S. bond market fund, and I own all the bonds that are available to buy. And that's the majority of our stocks and bond investments. However, I do own some additional TIPS, which are inflation-protected securities. And there were times when I had about 5% of the portfolio just in a small cap index fund. I eventually decided to move it out of that and just put it back in the total stock market just because I didn't want to think about it. I wanted to make it even easier. But people don't even have to go that far, do they, Matt? They could just buy a target date retirement fund. Mm-hmm. My expected retirement date is X. Let's say it's 2050. So you buy the 2050 target date fund. And then the fund managers will keep a portfolio asset allocation that is appropriate for that age. Mm-hmm. And you just go, okay, I'm going to trust they can handle that. They're not picking stocks, not picking winners or losers. They're still buying indexes, but they are taking control of the portfolio asset allocation. So you don't need to do any rebalancing. They do that, and it will automatically rebalance and keep track with your age.
Yeah.
So what's your perspective? How do you feel about target date funds? What do you recommend people buy in their retirement portfolios? Do you mix it up a little bit more, or do you keep it really simple? What's your perspective?
Generally try to keep it pretty simple. There are lots of options out there. We're big fans of low-cost index funds or low-cost ETFs. If you get a large enough account, some stocks in there. Stocks don't have a direct cost other than buying, the initial buying, and then the eventual selling. They usually charge you a trading fee, but those fees have come way, way down, again, with the internet accessibility of stocks. But again, for somebody, especially if you're managing it yourself, I think you want to keep it very simple. I have no problem with target date funds, especially if you're not going to be very involved, because the most important thing is when you get to about 5 years of when you think you're going to retire and start using that money, you don't want to have an overly risky allocation, because if you have bad timing from when you want to retire and the stock market goes into bear market mode right as you're about to start using that money, it can really change your retirement. A lot of people learned that lesson the hard way in 2008. Their equity allocations were really high, 70, 80, 90%. They were hoping to retire in 2008 or 2009, and then we had a 40% decline. Well, that changes everything, because when you start to take money from a portfolio, the rules are changed. Everything is different, and you have to have a distribution strategy to manage markets, to manage income, and manage pensions, manage Social Security, manage taxes. So within 5 years of retirement, you want to be very interested in what your allocation is and making sure somebody is monitoring and helping you balance that risk.
Now, I hesitate to add this because it's a whole nother can of worms. But for the cash that I keep on hand, I actually keep it in stablecoin. And I'm not a crypto investor. I think I owned a few Bitcoins a number of years ago, but I don't anymore. But I do own stablecoin because I can get a 9% return from BlockFi, or you could get it from Gemini Exchange. But I own the Gemini USD coin. There's some risk involved, but it's not a volatile cryptocurrency, but it's giving me a 9% return on my cash while it's sitting there in a high inflationary environment. And that's just one element of the overall portfolio that we talked about. Mm-hmm. And that's really, really key, is all the different things that you either own or are liabilities need to be considered when you're considering your portfolio. It's not just what you own in the market that's important. And as Matt has discussed a number of different times in a number of different episodes, you want to think about your bucket strategy, because you want access to capital in different forms that have different tax implications at retirement, so that you're as tax advantaged as you can possibly be when it comes to withdrawing that money or accessing that money. Mm-hmm. So, Matt, we got to wrap up, but we've got another episode coming up next week. You know what we're covering?
I do. We're going to talk about how to keep your income, your family, and your estate safe and sound.
Well, that sounds nice. I like safety. It is very important.
It is.
Okay. That's it for today. Keep thinking big about who you are and what you offer the world. And one last thing before you go, don't stress about this stuff. Just learn a little bit at a time. What am I going to learn next? Like, pick up a book that you think might help you. I'll give you an example. Say, The Simple Path to Wealth. Great book by Jim L. Collins. One of my favorites. Really simple. You're going to hear what we talked about. You're going to hear it in the book, and it's going to be even more detailed. So that's a great place to start. But don't panic. Don't worry. As my mother says, everything will be fine.